evening, everybody. Uneducated Economist here. So I had a few people ask me to try and explain what it is that's going on with the big banks and the short-term borrowing interest rate spike and the Federal Reserve and their overnight repo. This is a very complicated one. It's very convoluted in the way it goes, so I'm going to try and break it down uneducated economist style. The big banks, the financial institutions, the Goldman Sachs, JP Morgans, those guys, when they have assets and liabilities on their balance sheets, the assets are the treasuries and the other loans that they have made. Treasuries, mortgage-backed securities, auto loans, cash, that's their assets. The liabilities is all the money they have lent out that they are promised back. So that's the liabilities. The assets are the promises that they have been made. So whether it's a treasury or a mortgage or whatever it is, that's their asset. Now, generally, banks really like holding treasuries as part of their asset sheets because they can use treasuries as good as cash. They're almost as liquid as cash, but they're not cash. So when these big banks, typically how they would operate is that when they had excess reserves, they would loan their excess reserves to the banks that were in need of reserves. This overnight lending rate would be the effective fund rate. And the Federal Reserve would buy and sell treasuries off those banks in order to establish that effective fund rate. Now, the federal fund rate is just a target rate. It's like, hey, boys, this is what we're shooting for. The effective fund rate is what those banks actually end up lending to each other on that overnight basis. Now, the Federal Reserve has had the big banks have a reserve requirement that was basically referred to as an abundant reserve system. And then the Federal Reserve was establishing interest rates on interest on excess reserves. So the big banks would have their money basically on deposit at the Federal Reserve where they would earn an interest rate called interest on excess reserves. Now, what has recently happened is that these banks had come into a liquidity crisis where they didn't have enough cash, where money was pulled out of the system. And they have a lot of excuses for this. One of them is that these treasuries that is coming out of the federal government because they have gone going into so much debt lately, sorry guys, that there's a flood of treasuries out there in the market. And that it's sitting on these banks' balance sheet and not a lot of cash. At the same time, corporate tax date was like September 15th on their quarterly tax date due. So they were probably pulling a lot of cash out in order to pay their taxes. Now, going on over in the Middle East, you got Saudi Arabia, who's just got bombed, taking $400 million worth of cash revenue. And these guys need to make their debt payment that's generally in cash, US dollar base. So they're selling assets as well in order to come up with the cash to make their payments. So that you can see this drain of liquidity's taking place. All at the same time, the Federal Reserve has been tightening up the monetary base, all the cash that's out there. So you can see this has created like the perfect storm for a liquidity crisis or a liquidity crunch or a liquidity panic. It's not a crisis yet because, the system hasn't crashed. There's people still making payments and stuff. But it was a liquidity panic. And when there's no liquidity out there to borrow, the interest rates rise until somebody starts giving up their cash. Now, the Federal Reserve is stepping in to do something about this, and they're doing it through something called let me make sure I get this right, there's two ways to say it. The overnight repo rate. The opposite of the overnight repo rate is the overnight reverse repo rate. Okay, so the overnight repo rate is when they buy treasuries off the banks. This is a form of quantitative easing. The reverse repo rate is exactly the opposite, is when they sell treasuries to the bank and take the liquidity out of the market. And it's all done on a very short-term basis, establishing the interest rate for short-term lending. This is the whole plan of the Federal Reserve in order to deal with this liquidity panic that has taken place inside of the banks at this time. I hope I got that right. Uneducated economist, you guys let me know.